Welcome to Tradiers of Trader's Edge. I am Jim Murio. That's Bob Iacchino. Thank you guys for joining us. Bobby, what are you doing to celebrate the holiday today?
Just stop. I mean, you got to start with that right away.
Yeah, I had to catch you off guard. Hey,
no, that's actually amazing. This is one of those things, and I don't want this to be weird. Okay, nobody has to get weird about that. But this is one of those holidays where I've known a lot of people of a lot of cultures, and I've never heard anyone say, why don't they make this a holiday, which I found interesting. Now, before anyone jumps on me, I never heard that about President's Day. I never heard about really any holiday except for like your Christmases and your Easters and your 4th of July. Those are the only ones people ever said, we really need to have a federal holiday on this. Yeah. I never saw anybody say, we need to get this Juneteenth off. I mean, I did learn about it once and I forgot about it, just like I forgot about Columbus Day.
Yeah, but the history of it was funny. Like Donald Trump had a speech that was on June 19th, and the left was trying to find something to criticize. So the part that, okay, and we got to get to the guest now. The part that irritated me is that half the population was like, you don't know what Juneteenth is, and I'm like, no, I don't, and neither do you. You're making it up that you know what it is to try to make yourself seem intellectually superior and more culturally diverse than I am.
The only thing I like is that you were saying Juneteenth, and I went to the dentist this morning. So
that's nice. I went to the dentist 2 days ago. Good. But anyway, people, thank you for joining us. We are going to talk about markets and economics. We actually have a kick-ass guest today, one of our favorite guests, and you can say what you want about Bobby and I, and sometimes our opinions are wrong, but we get great guests. Today we have Brian Wesbury, who is the chief economist for First Trust, one of our good friends, literally one of the brightest minds in economics. So without further ado, let's bring him on. I tried without further ado, and it didn't sit right with me. I don't like it. And the reason I do these exercise videos called Mad Fit, and the girl who does them, she's French Canadian, and she says without further ado, but she speaks French and shit. So it goes way better there. I will never say it again. How are you, Brian Wesbury?
I am well, Jim and Bob. It's great to be with you. It's been a while.
It has been a while.
I know you got to get past the silliness. I do have to say that, like this, the holiday itself, I'm happy for the day off. I'm glad about it.
Yeah.
And this way, like I'm actually talking to you guys with some energy and actually started the show with a smile on my face, mostly because of Brian. Jim is usually the opposite. He negates my smile. But the rest of this, it's like, I'm happy for the day off. So I'm all good.
Me too. And I'm happy to celebrate the freeing of the slaves. That was a dark time in our history. If the holiday came about in what I considered proper channels and not out of spite, I'd love the holiday, but I can never decide if we're supposed to feel shame that we had slaves in this country, which I did not have slaves. My people were Italian. I am actually part African. Or are we supposed to feel celebratory because 500,000 men died to free the slaves? Brian, do you have any insight on that? Was that taught in economic school or no?
All I can tell you is I was in a car the other day and the driver was saying, we need to make St. Patrick's Day a national holiday.
We need the day after
to be a national. People don't know this, but St. Patrick was taken into slavery. And that's a big part of the story of St. Patrick. And so if you really want to talk about that, why don't we make St. Patrick's Day a national holiday rather than making everybody skip work just to drink too much?
So I'm from Chicago, obviously spent 99.7% of my life there. Brian, you're from Chicago, at least spent a big chunk of it. I don't know if you were born there. Jimmy's born there, raised there. St. Patrick's Day, for those of you watching, if you have not spent a St. Patrick's Day in Chicago and you like St. Patrick's Day, okay, that's a big part of it. Yeah. All right. Unless you're in Dublin or Boston, there's likely no better place to do it. They dye the river green. The entire city shuts down and turns green, from the people to the vomit. A few hours later, everything's green. But the funniest part for me about it is I was always annoyed by it because I grew up with a bunch of Irish guys, O'Connell and Dunn and Daly and Sturrett and Flanagan and O'Shea. All these guys were my friends. And every time St. Patrick's Day, I'm like, oh my God, you guys are as bad as the Italians. You make fun of the Italian horns, but you guys wear the colada rings and you wear all the green. It's the same. We're the same people. We just tan and you don't. I have a point here. So in order to enjoy St. Patrick's Day, I read a story, no clue if it's true or not, that St. Patrick's parents were part of the Roman aristocracy. And because of that, I had a shirt made that said St. Patrick was Italian. You're welcome. And I got beat up more on St. Patrick's Day than any other day of the year.
I was, you know, when I was young and worked at the Harris Bank in Chicago, and I am not born and raised in Chicago, but I came there in my early 20s. They always let us out early if you had to take the train home because you didn't want to get on the train after about 2:30 in the
drunk train.
afternoon because there was vomit everywhere. And so you couldn't sit down if you waited till like 3 o'clock. It was too late. You know.
I just had something I was going to say that was kind of off color. We were talking about ethnicity. We can do this, whatever. I'll keep it tasteful. But the ethnicity of women and what like you're attracted to physically. You know, I have a pretty broad Italian, so I have a pretty broad thing, and I always really like Irish girls. And then my wife was like, "Yeah, because when you were talking to them, they're always drunk, and they would actually talk to you." And there is some truth in that.
I'm a huge Margaret fan. I really
Margaret is funny. Okay, let's talk about some level of business here. So I actually think the data of the last 2 weeks has been fascinating. The inflation data has come in a little better than expected. Now, everybody seems kind of celebratory about that, but I have a feeling it's because there are deep cracks and fissures in the system that we've been papering over with either government spending or with bullshit economic data that does not tell the whole story. Can you go into that a little bit, Brian?
Yeah, you know, in the UK, inflation actually the consumer price index just hit 2%. So it seems to be coming down everywhere. You know, part of I always divide CPI away from inflation because CPI is just our measure. All right, we try to measure it. Inflation is really the money printing. That's what it really is, and then we try to measure it. And there's no doubt that supply chain problems during COVID, all that. I think the numbers, you know, 8 or 9% inflation, they were a little elevated because we were measuring inflation wrong. We kind of got caught up in that supply chain thing. I think inflation was probably 5 or 6 just from the money. But they've now squeezed the money supply. It's down in the last 18 months. So I'm having part of this is I have less conviction about forecasts these days than I've had in a long, long time because we did the craziest things during COVID, things unprecedented things. We've never done them before. So yes, I think inflation's coming down, but also yes, if you look at that retail sales report we just had yesterday, it was ugly. There are initial unemployment claims all of a sudden are popping up. Job growth is slowing down. We know all these buildings are $180 million buildings are selling for 20 million. You know, shopping centers are selling for cents on the dollar. There's a lot of signs that things aren't as good as people kind of think they are if you just look at the stock market.
So okay, there's something. Everybody I know who's a good, solid economist looks at what happened in Japan, and they say, okay, Japan most likely can't get into their heads and ascertain intent, but they saw supply chains locking up around the world. They then use that as an opportunity to shake the shackles of 3 decades of a deflationary spiral. There was intent there. But anything, when you bring it back to our country, and I always talk about, I know you guys know, I say, I want everyone to remember that the inflation was a policy decision. It was intentional. They were for 10 years prior to COVID. They were irritated that they couldn't. I always equated it to guys trying to start the charcoals at a barbecue. And finally, they were just like squeezing the whole bottle on it to try to get the charcoal started. That's reasonable, right? It was a policy decision to some extent, correct?
Yep, totally. That's a great analogy. And they, by pumping all that QE, all these reserves in the system, and this is what people don't realize how much they changed monetary policy in '08. I mean, I believe dangerously so. We went from a scarce reserve model, and by the way, these words are out there. The Fed writes about them. There are academics that write about them, but if you go in that room with Jerome Powell and you're a journalist, you don't ask about them. It's like nobody talks about it. It's the craziest thing. But we went from a scarce reserve model to this abundant reserve model. Banks used to hold 10% reserves. Now there's like 40% reserves. My analogy to go along with what you just said, Jim, is that it's like we're storing gasoline next to our water heater, and they're just part of them wanted the gasoline to get a little on fire, and they couldn't do it under Bernanke, but a whole other part of them is scared to death that it's gonna catch on fire now that we've experienced some inflation. And so this whole system is, I believe, really vulnerable for some dangerous things in the future if they lose control. And I don't, for the life of me, I can't figure out why they did this, because they held interest rates artificially low at the same time they were pumping in all of this money, and they just believe with regulation that they can keep it from turning into bad things, and they can't. Right now banks have $680 billion of losses on their books. The Fed has $1 trillion of losses on its books. And if you go back and look at subprime, it was less than $400 million
Wow.
or billion dollars.
Yeah, I
So
know what you meant. Yeah.
half of what we're talking about today.
Right.
So they've created a situation that is way worse than when all this started.
So, Brian, and before I ask you this question, Jimmy, can you go retweet that thing? I have a friend named John DeSorga, Wall Street guy, lives down here now. It's banker down here. And we were talking. He asked me, he goes, send me your macro view because I'm trying to straighten out what I think. And he's a very smart guy.
Mm-hmm.
And after I sent him my VAC, I happened to have been on Bloomberg about an hour earlier from when he texted me. So I had notes all written up. So I just copied and pasted them and sent them over to him. And it was my whole macro view. And then he asked me afterwards, he said, so I want to read this. I guess in terms of your macro view, the broader question is whether we're in a new structurally inflationary regime post-COVID, and this is a pullback, or is it a return to Goldilocks? I never heard it called a new structural inflationary regime. Do you think that's a possibility, or do you think that's what this is?
Yeah, it's possible. And I'm again, having confidence about what all this means, given what I just said about how we shifted from a scarce reserve model to an abundant reserve model, how we've blown up the size of government massively, and we never took it back to pre-COVID levels. Before that, we never took it back to pre-08 levels either. So Bush and Obama boosted it, and then Trump and Biden boosted it, if you just want to look at who was president, and it just keeps getting bigger. I would argue that it really comes down to M2. So that, everybody else, all we talk about is interest rates. Are they going to go a quarter, cut a quarter, raise 50? I think we have to look at M2. And if you look at M2, they finally got it under control. So if I had to forecast inflation right now, in fact, our forecast is that it keeps coming down, and that we're probably back to that 2% level by next year sometime, that they've actually had success. Now, does that mean that we won't have a recession? No, I don't think it's Goldilocks. I think we're going to have a recession with inflation coming down because they tightened money too much, and that's what causes a recession. I'm a Friedmanite. It was easy to see the inflation coming. Bob, you're absolutely right. It was planned. It was designed. Like there's no way other to think about it. You could see it coming. even though people didn't want to believe it. But now the money supply has gone right off the cliff the other side, and that usually means a recession. So that's why my call is still a recession within the next 12 months.
Okay, so follow up to that. And first of all, it's Jim that has been parroting
Oh,
the
sorry.
planned inflation.
Yeah.
That's
You want
okay.
credit.
I want to
You
give him
yeah.
credit
Short
because
guys need credit, right?
I
Yeah.
want to give him
Yeah.
credit because he's right. You know, he's been right about it for a long, long time, and
Yeah.
people can't seem to accept that they wanted some form of this to happen. Maybe it got out of control, maybe it didn't. But to your question about the recession, so there's, I think, and you can correct me if I'm wrong about the numbers, there's 674 billion in the Treasury general account and 1.8 trillion in planned deficit spending, and those numbers are never revised down, right?
Right.
They're only revised up. And then after you answer that, we have a viewer question from M. What about the debt of ordinary people in the United States? So obviously credit card debt's going up, delinquencies are starting to going up. So what are your thoughts on those two things? Are some of the things that could avoid a recession, the fiscal spending that's planned and maybe the Treasury general account? And then what about individual consumer debt?
Yeah. So let's just go to deficits real quick. I'm a Friedmanite. I'm an anti-Keynesian, and so I never believe government spending is good. However, in the short term, like we saw, COVID was as clear as can be, right? Pay everybody to sit at home, and they spent. All right, and clearly you could see the short-term impact of that. Well, in 2022, the deficit was 1 trillion. In 2023, it was 2 trillion. And this year, 2024, it looks like it's going to be about 1.9 trillion. So that extra trillion of spending last year, clearly, I believe half our growth, half of the GDP growth that we saw last year came from government spending. This year, you have to keep increasing the size of the deficit to add to the economy. So this year, they're actually going to spend a little less. It's not much different, but I think that stimulus is gone. And then you come to this Treasury General account, and so this is I mean, this is amazing to me. That this thing, the Treasury has a checking account at the Fed. Up until 2007, you go back for decades, it had like 4 billion, 4.5 billion, 5 billion. Maybe it went up to 5.5, but they had settled on five. Five is about what it should be. And if you're the Treasury, that makes sense. Some liquidity and got to pay for a new warship or something, and you can just write the check. All right. But today with 6, 7, 8, 900 billion, I've seen numbers like we had over a trillion at one point. Is that money spendable? Can they just take it and spend it? And it takes Congress to spend it. So it's not clear to me that the Treasury can just take that money and run it back into the economy. All right. And so they need a congressional piece of legislation and the president has to sign it, then they can spend the money. So I wouldn't worry about that sitting there. And then what about consumer debt? I mean, we're seeing delinquencies start to rise. This is one of the problems with getting a bigger government as a share of GDP, and this government grew in 08, 09, grew again during COVID, and it's not going back, is that means our growth rate, underlying growth rate slows down. I think right now in America, we're about 1.5%. And if you want to put that in context, that's France, Spain, Italy. They've been there for 40, 50 years. And then we have 1% population growth. So if you have 1.5% growth minus 1% population, that means average incomes are only going up 0.5% a year. And people that own assets, this is another thing that Jim is tweeting about is I want to make sure I didn't have another Biden moment there. That Jim is tweeting about all the time is that the inequality it was designed. If you own assets, stocks, houses, land, you won during COVID. If you don't, you lost. And so what's happened, this is why Biden's popularity is lower than Carter's. 70% of people say America's not working for them because on average, wages are only going up 0.5%. And we know the winners won way more than that, which means those people that are below the average have seen a decline in purchasing power. They tried to keep it up with credit cards. Now they're going into default. Auto loans are going into, we're seeing defaults rise on consumer debt all over the place. And this goes along with my retail sales view that that number was ugly, that initial unemployment claims are beginning to pick up. I think a recession could kind of hit everybody out of left field because nobody's paying attention to M2 and it declined for the first time since the Great Depression. And that means that doesn't mean that's not good. And Friedman said that's not good.
So
Jimmy,
it's
doesn't
only-
this remind you of when a couple of years back when everybody was saying inflation is going to 1.8% and Bianco was like, no, it's not.
No, it's not.
And he was
Yeah.
right.
He
That's
was
what
so
this
correct.
reminds me of with the recession call, because right now everyone's like, nothing's pointing to it. Brian's going, not saying tomorrow.
No.
Mhm.
Yeah, I think it's going to
Yeah.
happen big. By the way, just for some context on it, there's been 5 times in our history that M2 money supply has contracted by more than 2%. First
Mhm.
4 of them were 3 were a depression, 1 was a recession that looked like one. For perspective, we declined M2 money supply by 4.6%. Granted, there was a mean reversion element built into that because we'd expanded it so quickly, but it's still relatively significant. There's another point I wanted to make real quick before I want to talk to you about the jobs market because I think it's fascinating. It's bullshit. One thing that I try to get out there is that Democrats, deficit spending, huge debts, weakening of the dollar, that makes me rich. When they were doling out $1,400, like I'd say to these people who are arguing for the Democrats, you're getting $1,400 in this round. My assets are going to go up $250,000 in this round.
Right.
Democrats make me rich. I fight hard to get them out of office. That's just because I don't know why it is.
Right.
If I was truly selfish, I'd want Democrats in.
Right.
Barack Obama was great
Yeah.
for the rich. Yes, Bobby?
Before you go to the question you had about the jobs market, we have a viewer question about how M2 affects the housing market, and I want to put that up before.
Yeah. So we printed 40% more dollars. If you look at from the beginning to end of COVID, it might be 37%, but it's right. Let's just call it 40 to make it all the numbers easy. And when you add 40% more money to the economy, technically the value of the dollar falls by 40% more than it would if we hadn't done that, right? So if you translate that to house prices, they're going to be up 35, 37, 40%. And so I would argue that's a permanent increase in house prices. In other words, everywhere. Now, Naples, Florida, it was 200%. So that probably overdid it. They'll probably pull back, but they're not going back 200. All right. We're now at a new level because of all the money we printed. Now, having said that, housing's going to be really interesting because we had these artificially low rates for 15 years. I mean, 9 years out of the last 15, interest rates were 0. And that meant mortgage rates. I mean, if you borrowed, I have a 2 5/8 30-year mortgage. I borrowed, I didn't put a penny down more than 20%. All right, that I borrowed every cent I could. That I have to have coffee to wake up in the morning. That day I didn't need coffee. I ran to the bank and I'm like, "Where's the paper?" I'm like, "I can't believe you people are such idiots." All right. And that paper now on the bank's books is trading at 76 cents on the dollar. And so if I could somehow get them to sell me my loan back, I could save 25% of the price of my house. And that's just amazing to me what we did. And so now with rates at 7, everybody feels really weird. If we do have a recession, like Jim and I think, then those rates are going to come down. On one hand, that will help the housing market. On the other hand, though, we're going to in a recession, and that never helps the housing market. So you've got kind of, we're not in '08. We're not going to see a collapse in housing. And these prices, they're up because we printed too much money. It's not because we're in a bubble. Houses are not overvalued. That's one thing I try to remind everybody all the time. It's because we printed all this money.
The dollar's undervalued, right? That's what
Yes,
we were just
that's
talking about.
exactly.
Bobby and I just did a show a bit ago, and I was just saying, yeah, the dollar, just the range that it's traded in, because the dollar's gone down, gold has gone up.
Yep.
By the way, so another quick thing about bubbles, and everyone's saying this is an everything bubble. It can't be an everything bubble. It reminds me of a conversation I had with, I think his name is Robert Schiller, who won the Nobel Prize for defining bubbles, and he gave his definition. I said, wait a second, because every bubble I've seen is way more characterized by levels of debt in the wrong hands, like mom and pops leveraging up. Mom and pops leveraging up with 5 homes that they have in these mortgages that have to adjust. I don't believe I see it. I don't see anyone saying, "Oh, I bought 3 more homes and I'm flipping them." So that's not the case. So I agree with you 100%. Let's talk about jobs real quick too, because we've talked about government spending. We haven't talked about these jobs numbers over the last year and a half. I think have been mostly trash.
Yep.
Just put perfume on them, put a bow on them, make the headline number look good. Career jobs, full-time jobs have gone down 1.5 million, and I'm just rounding these numbers, people.
Yeah.
Second and third jobs, which are to me indicative of people trying to get by, those have gone through the roof. Brian, what do you got on that?
Yeah, no, there's a million ways to look at this. Well, at least a couple dozen. And that is, there's 2 surveys. We all know this, or I hope we know this. There's 2 surveys of jobs. One, we ask institutions. So you have a company, you have a restaurant, how many people work for you this month? And then you fill out the form and you tell them it's 62 this month, it was 58 last month. So there you go, 4 more jobs. We have government institutions in there, but there's like 400,000 people that make the survey. All right, or companies, institutions that make the survey. The other one is 60,000 households, and we knock on your door. At least we knock on your door the first time, then we make a phone call, and you stay in the survey for 6 months. And so what's interesting about this, think about it. If you have an existing group of institutions that are in the survey, 400,000 of them, it's a lot, but you're not adding new ones until the next year when you redo the list. And so you're not capturing new business startups. When you knock on somebody's door, and there's somebody that just opened a restaurant and they took a job at this new restaurant, you get that counted. And so that's the big difference between these surveys. And right now, that institutional survey is gone through the roof. It's up. I forget the exact numbers, but we've added. Let's just, don't quote me on these numbers, but they're close enough. We've added 2 million jobs there. But in the last year, that household survey, when we're knocking on doors, we've only added 400,000 jobs. And this is one of the biggest differences between those surveys we've ever seen. And what that tells me is that new business starts aren't happening, that small business is hurting, the ones that aren't in this survey that that we miss. And when we really knock on people's doors, we're finding out jobs aren't growing. And one of the reasons that that's true goes to the second way that I would talk about this. When you look at the payroll number, that's the big number. It's showing 200,000 jobs a month and all these great things. Government jobs are growing 3% per year right now. That's in the last 12 months. Private sector jobs are only up 1.8%. So a lot of this is government driven growth.
Are you including healthcare and education in the
No,
government number?
as of right now, not, but I'm just about to add that.
Oh, I'm sorry.
So no, that's okay. Then the second thing is education and healthcare, which clearly, I mean, government's way over half of the healthcare spending in the country. Education is all the public school teachers, et cetera. Those jobs have grown as well. And then I would also throw in what we call travel and leisure. So it's all the sports venues and cruise ships and theaters and everything that was locked down during COVID, they are still coming back online. And so if you take those three sectors, so and the one's government, one's a lot of government, education and healthcare, and then one's just reopening from COVID. Take those out, and our job growth is really weak. I forget the exact number on average over the last 12 months, but it's a third or less of the actual numbers that are being reported. So everybody says this economy is doing great. I believe half our growth last year, half of it was because of government spending. And you can see it in in the numbers we just talked about.
So we got another viewer question, and I don't want to miss any of these. It's from Ditto. And Leslie, I'll get to yours next. Ditto's asking, isn't it possible that the 40% increase in M2 also could mean that the cumulative inflation is 40% higher? Now, I want to point out to people that the CPI data that we get is a rate of change figure. Okay, when you get plus 2.8%, it means it was up 2.8% year over year from the last reading. While you're doing this, I'm going to send Logan there in the back room. I'm going to email him the CPI index, and you guys can see that it really rarely comes down. So when they say it's coming down, but go ahead, Brian.
Yeah, the only time it really came down in sort of our lifetimes is 08, 09, when the economy, when financial system was shutting down because of the subprime, really because of mark-to-market losses, but leave that aside. And then the second thing was we locked everything down during COVID. So, I mean, oil prices plummeted, everything plummeted because nobody bought anything for 2-3 weeks there. But yes, technically, the way I said it before was print 40% money, and prices will be 40% higher than they would have been without that. Now, having said that, the key words there are would have been, because if you print 40% more money, what Friedman would say is you're going to get 40% more spending. Now, some of that is inflation, but some of that is we're buying more cars, we're buying Pelotons, we're buying more meals out at restaurants. So some of it's what we call in economics real growth. We printed 40% more money, we got 8% more real growth over the last 3 years, and then the other 32 is inflation. So it has to add up to 40, but it doesn't, the price of everything doesn't have to go up by 40. Now, I probably have confused people because I said your house price went up by 40%, but all I was doing is kind of making the case that it's the money printing that raises the price. Do I know that it's 40? No, it could be 32, it could be 35, it could be 29, could be 44 if we don't make enough new things. And so but the whole point is put more money in, you're going to get more spending. And if you put money in too fast, faster than you can increase output, that's what turns into inflation.
Bobby,
All you guys have to do is go to fred.stlouisfed.org, find CPI. One of the charts will show you the rate of change. And then the other chart is the one that I'm going to ask Max to put up right now, is the actual index. Okay. And if you look at the trajectory of this index, guys, just to get this question answered, when you see politicians or whoever saying inflation is coming down, no, it isn't. Okay. It's not. It's rising more slowly. I mean, you go back to that little gray highlighted area, which is the recession of, God, I can't see this. Can you guys see
that? It's COVID. No, that's COVID. 2020. I can see it.
You're right. Sorry.
Yeah, I have my reading glasses on.
There you go. Yeah. So, I mean, you literally need something like COVID for inflation to come down. So why were they complaining about inflation, as Jim pointed out? It's because, this is only a 10-year CPI chart, so it's 2020, but they're complaining about it because it wasn't rising fast enough to rescue them from the excessive debt they've taken and reflate their way out
Yeah.
of debt. And Brian, feel free to correct Jimmy on that if I said it wrong, or correct me on that. But I don't think it's wrong. Inflation is not coming down.
Yeah. No, it's
Not
not.
yet.
And the rate of increase of prices has slowed down. But the question is really good. And I mean, here's the here's a big question. Now, if you want to get a little deep into economic theory, do we really need more money? And if you read the Austrians, Mises, Hayek, they will say no, absolutely not. Remember, every dollar is 100 pennies. Every penny can be divided into hundreds if you want to. And so what it's never true that we don't have enough money. What is true is we don't have the right prices. And there is a huge resistance, and it's gone back. It's human nature. You don't want to sell a bushel of corn for less this year than you did last year. You know, and that would be deflation, right? And so if you go way back, we were on the gold standard. By the way, if you would have run that CPI chart, so that was the actual index. So we measure them and we put them all together, and then we give an index of prices. And so that was what it was. These are the prices of all things. If you went back pre 1800s or in the 1800s all the way up to 1913, inflation was flat, 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 flat. Then we invented the Fed in 1913. And guess what happened to the consumer price index? It immediately started to go up. That's because, you know why? That's when we started printing money and adding it to the economy. And then just to add one little more modern era thing to this, if Bitcoin was our money and you can only have 21 million of them, you could never have inflation, because we can't print any more Bitcoin. I'm going to the end of Bitcoin. I know we've lost a bunch and we haven't mined them all, but Bitcoin, there's only 21 million. That's it. They could not have done quantitative easing. The Fed could not have bought all those bonds from the Treasury to inject that money and pay people to sit at home and not work. The Treasury, if they wanted to do that, would have had to go into the real financial markets and issue new bonds. And you know what would have happened immediately is interest rates would have shot up right away. They avoided that because they printed more money and let the government spend the money we printed. That's why this all created such a mess. That's why we got the inflation we had. I wish we were on a Bitcoin standard or back on a gold standard, because then the Fed couldn't mess around like this.
Well, I might have what's a slight disagreement with you, which is very, very unusual. So tell me this.
Careful.
Be careful when I disagree with guys like Bianco and Wesbury. So tell me this, that do you think part of our living standard is that inflation is somewhat baked into the equation? Now, 2% is probably too much. Let's say if we could consistently control it at 1.5%, which I know is absurd to think we can control it once you let it out of the bag. But you do acknowledge that by pulling forward providing incentive for people to borrow and buy assets and buy on leverage has increased our the way we live. Definitely.
Mm-hmm.
I mean, so if we could control it at a low level, it's not 100% a bad thing, correct?
Yeah, I mean, I think I understand what you're trying to say there, Jim. But give me just a second to go back. All right, there at the turn of the century, the 19th century into the 20th century, there was a politician, William Jennings Bryan, and he gave a famous speech in Chicago. It reverberated around the nation. He was trying to get the presidential nomination on the Democrat ticket, and it was called the Cross of Gold speech. And what he said is, "Do not crucify us on a cross of gold," because we were on a gold standard back then, and people felt like, I can't raise my prices, and so then the question is, well, if you can become more productive, produce the same amount of corn or more corn off the same amount of acreage, why wouldn't you sell your corn at a little less? You're getting this, you might get more revenue from your farm, even though you sold it at a lower price because your yields were higher. And so then you go back and you go, what was going on then? And we were inventing the tractor. And so one farmer would get a tractor, let's say, and then all of a sudden his productivity would go through the roof. Like he's now got 50 bushels an acre, and gets it all done with fewer workers. And the other one only has 40 bushels per acre and has way bigger of an employment base. And so the one who is more productive can sell their corn for less. The one who isn't can't. And as a result, the one who couldn't make a profit, couldn't increase their productivity, they started to complain and say, well, if we just had inflation, I wouldn't be forced to sell my corn for less, and I could make a profit again. And so what I would argue is that money is an extraneous thing. We would still have debt, we would still have borrowing in the future. What printing money does and inflation does is just sort of it undermines long-term planning. Now, you may be right. If we have 1.5% inflation a year, one, even two, that's the whole point of this, is that those low levels don't change planning very much. When you get to 7, 8, 9, like we just had, now you're all blown up. Every project goes over budget, everything just gets blown up to smithereens. But in the end, if I think if we, at least when I really think about it, it's the amount of money in the economy doesn't matter. It's because we would still have debt, we would still have borrowing, we would still have all these things. And going from the gold standard to the Fed, which is what that was the William Jennings Bryan didn't force it to happen, but boy, that speech that he gave, it's famous. It's historically huge speech. And I believe he led to the creation of the Fed. There were other forces too, but that speech, and it was all because some farmers couldn't make a profit because they just couldn't, they didn't have a tractor. They couldn't increase their productivity as much. So they blamed Wall Street and the gold standard for their problems. And that's why we invented the Fed. And ever since we invented the Fed, we've had more problems, or let's put it this way, different problems than the ones we had before.
Yeah, it seems to me, Brian, tell me if I'm crazy, that they just meddle too much.
Yep.
And that's the problem, is whenever we create something that might be good, it's still run by humans who
Yep.
are just innately flawed. And I always use the example, Jimmy, of like agriculture, just do like a small version in your own yard. It's like the closest you can get to a plant that you just plant and it grows and you pick it when it's ready is the best plant, right? But
Hmm.
then, yeah, it didn't rain, so I'll add a little water. Well, now I waterlogged the soil and I've got mold, so I got to add a drying agent. Now I got to put some nitrates and some food in there. Now I've attracted the bugs, so I got to do some pesticides. That's the Fed to me, because they've meddled
Yep.
so much that we now have an economy that has very little nutritional value, if I could
Yep.
mix metaphors. Real quick, we have a
Perfect.
comment from Leslie and then another question from Ashley that I wanted to get to. And you, Brian, correctly, did you work for TD for a while, or a Canadian bank? I seem to remember you being somewhere, but might have been Harris when they got.
Yeah, I worked at Harris when we got bought by BMO.
Okay, but
So
you didn't
that was
stay
way
there. You
back
ended
in
up
the
moving.
80s. It was
See,
way
that
back in the 80s, but I did
I
not
asked
work for a
because
Canadian bank.
Leslie, I think, is Canadian, and she's watching the show. She says the growth of the government sector is even higher or worse in Canada. I don't know if that's
Yep.
something you watch. And that actually brings about an
True.
interesting thing to me. Do you think it's normal or something to keep an eye on that Canada, then the UK, or was it the UK? Was Canada and the ECB for sure? I don't remember if the
Yeah.
UK did it yet or not. Cut rates before the Fed,
Right.
and they cut rates basically adding another sort of batch of lighter fluid to their inflation theoretically by strengthening the dollar. Is that a bad thing? Is that unprecedented?
Yeah, no, we one of the things that happened when we switched from and by the way, Canada did it, UK did it,
Denmark.
Denmark, ECB, everybody did quantitative easing. And all, if they didn't start in '08, they did it in COVID. All right. And when you switch from a scarce reserve model to an abundant reserve model, so you guys know this because you live this, but before '08, every single bank in the U.S. at least, I'm going to talk about the U.S. Canada, it's a different kind of banking system, but seven massive banks, I think, or maybe it's six now. But in every single bank in the U.S. had a federal funds trading desk. Every single one. And the reason is there was only 10% reserves in the system, and you had to make sure every day you had 10. So you would call up the bank that had 10 and a half and borrow their half. So your 9.5 would be 10 and everybody'd be 10. And these are trading desks. They're screaming and yelling at each other, every other word's a 4-letter word, and it's like, they're borrowing and lending Fed funds. Well, in '08, when we did QE, we flooded the system with new money. And guess what? Banks don't have federal funds trading desks anymore. We do not trade federal funds because no bank needs them, because every bank is over reserved. And so the question is, if all these excess reserves are in the system and there's no federal funds trading desk, there's no supply and demand, bid and ask, banks trading every single day, where the heck does that interest rate come from? Where it's not a market anymore. And I would call it price fixing. The central banks of the world are literally price fixing the short-term interest rates. And the federal funds rate is the most important interest rate in the entire world. And the Fed just makes it up. They are literally just making it up.
funny.
So if Canada and the UK are cutting, it's just because they can. By the way, the U.S. can cut too. The only reason they don't is because they're scared politically that people are going to yell at them if inflation doesn't go away, and Powell's worried about his legacy and all of that stuff. But they can move them, they can change them. Because those interest rates are no longer linked directly to monetary policy like they used to be. And people, no one is talking about this, and it blows my mind. Price fixing, I'll just give one example because some people hear it and they don't really know what that means. But let's say the price, the government set the price of steel, and they put it like outrageously high. Guess what would happen? It'd just be all rotting and rusting in the fields, right? Because nobody would use it. Let's say they priced it outrageously low. Well, then we'd be drinking beer out of steel cans, not aluminum, because now steel's so darn cheap. Well, who would use expensive aluminum? And this is what happens when the government sets a price, because we had the Fed has 400 PhD economists, 400 of the supposedly the brightest minds in the whole wide world. And what's their idea? Let's hold rates at zero. How many PhDs do you need to figure that out? Like, you don't need any.
So are you saying, Pete, they had 400 PhDs, like that's a handicap? And I used to be able to make that joke. My daughter just accepted a fellowship to pursue hers. I'm not talking about engineer PhDs. I'm talking about economics PhDs. But I think that's more of a handicap than it is an advantage.
Well, if you work for the Fed, that's where the handicap comes in, because you don't have to deal with the real world. Like, this is what's crazy to me. And by the way, you know why they held rates at zero? If you had 34 trillion in debt outstanding, and you got to make up the interest rate you paid on it, what would you set it at?
Bingo.
Yeah.
Zero, negative.
Yeah, well, that's what they did in Europe. Negative. What the heck? You can't have negative rates, by the way.
Real quick, before I give Jim the last 8 minutes of the show, I really like all this audience engagement. So I want to encourage it. Ashley has another question for Brian. How does productivity figure in the equation in the U.S.? And then Jimmy, just take it after that.
Yeah, Ashley, I know Ashley. Ashley, good to see you, and that's awesome. It's a big deal. If I'm Jim, if you and I are wrong about the recession, it's going to be because we underestimate productivity. And so, you have AI. I read a report the other day that Ozempic is going to boost GDP by 2 percentage points a year. Like that's our average growth over the last 20 years. I think this is way wrong. But if those drugs, whatever, the Wobegon or whatever all those drugs are that help people lose weight, if they don't kill people and they actually make them more productive and draw on the healthcare system less, it's a real positive. AI is the real deal. Starlink, it is already massively changing communication in the world, and you're going to be able to use your cell phone over the satellite system without any adjustments. You don't need a big antenna or some special big monster thing. Just your cell phone. It's going to work over Starlink. And that's just the tip of the iceberg. Those three. There's 200 more, and so productivity. My model, it's kind of art in a way. Like we have a big government on one side, that's the negative, but we have productivity and innovation on the other side, that's the positive. And if this is so positive that it overwhelms even our crazy government today, like we still grow and we avoid a recession. And so productivity shows up there. It also shows up in the inflation. So if you print 40% more money, but in productivity goes up by 10%, all the farmers use tractors, then inflation only goes up by 30%. So productivity is huge, and it could make the bearish me wrong. I've been bullish for so long. People call me a permabull, but these days I've been predicting a recession. But where I could be wrong is underestimating the productivity that's going to come from all these new technologies that we have.
I had actually like 5 different areas I wanted to go into, but I look at the clock and we're running out of time. But I want to have some fun real quick. So I just read a report from Bank of England. They are trying to ascertain the economic impact of a specific event that's going to be happening in late August through, I think it's through October, and how it is going to affect their general economy, and perhaps could restart inflation again. Can you take a guess at what that event is?
Football season?
It's got to be the election, right?
No, it's not the election. It does involve pop culture.
Oh my gosh.
Don't tell me it's Taylor Swift.
Taylor Swift's tour is over.
There are 10 shows that are going to be in the UK. I think my daughter's actually going to go to one of them. I think she has 10 shows in the UK, and it's supposed to, they are concerned about the economic boom it's going to cause. And
this is all Taylor Swift, huh?
It's all Taylor Swift related, which, by the way, makes some sense. I mean, Michael Jordan, they used to estimate that he injected perhaps $10 billion into the U.S. economy back in the 90s just by creating a buzz at every stadium he went to. So it's reasonable, right?
Yeah. There is, if we go back, there's one time in history that I have kind of decided where the economy moved completely different than the monetary policy or fiscal policy would tell you it went, and it was Lee Iacocca and the Ford Mustang. Everybody had to have one, and then other muscle cars got into it, and car sales like that year, that 24 months, were like twice as much as they would have been normally, and you can kind of see it. So like maybe but the way I always think about these things is if I have to buy tickets for the kids to go to see Taylor Swift or me, that means I'm not gonna buy a new 9mm. All right.
Yeah.
So it's like, so you get one thing that booms.
I love Brian.
I love the trade-off. That was awesome.
One thing wins, the other thing loses. That's the way I've always thought of this. But it's people might decide, well, they want more entertainment, and so the economy just gets bigger to accommodate it. It could be true, but But we saw it with the Mustang and muscle cars. We
Sure. But I
definitely
just wanted
did.
to add how wonderful a metaphor that was too, because it evokes guns and butter for back when we're learning economics in college, and it also is about right versus left. It just hit.
And you
right
also
to
talked
that.
about muscle cars, which
And
I
we talked about
so
muscle.
love.
Bobby was going crazy. He wants
I
he wants
still
every
love
muscle car.
Mhm.
So we're going to sign off, but I don't want to sign off before. We thank you guys for joining in, particularly this show. There was a lot of audience participation. We appreciate that. The platforms that Bobby and I do are nothing without the support we get from you guys, and it has been frankly amazing and humbling. Remember what we're trying to do here. Both Bobby and I were in mainstream media for 15, 20 years, and we found the influences of sponsors and the influences of walking a specific line that they wanted to walk completely untenable. So we decided to branch on our own where people can give their honest opinions. All our opinions might not be right, but at least they're our honest opinions. Thank you again. This has been Tradier, what's it called? Tradier's the Trader's Edge. I'm Jim Uriel. That's Bob Ichino. That's Brian Wesbury. Thank you, Brian.
Hey, great to be with you guys.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.